Hey folks, Sam I am here, and I have an announcement from the IMF. They are here to save us all. They have figured out how to make negative interest rates work. What will we do without negative interest rates to save us all? Seriously. Okay, let's jump into this article. This is the new bail-in. Now, if you don't know what a bail-in is, it happened, I think it was 2017 in Cyprus, where they basically closed the banks and then they decided, oh, we're just gonna take, I think it was 20 to 40% of your cash that you have in the bank, and that's ours now. Thank you very much, and have a good day. That's what happens when the governments go broke. They just, who can we go and rob from? But that is expensive. You expend a lot of political capital doing something like that. And, people don't trust the governments as much, and they don't trust the banks as much because they're obviously working together to rip you off. So I don't see that. A lot of people say, well, they're going to do that again, and that's going to be worldwide and on and on. And I don't know that they're going to do that because it has some unintended consequences that they're aware of now. And I think this is a much more sellable policy that they can get their minions to kind of push out and sell this to the masses, that this is a good idea. Let me just look at this article. We're going to cover all the benefits of stealing money from you. So let's jump in. Many central banks reduced policy interest rates to zero during the global financial crisis to boost growth. Now, that's a fallacy right there. I can't even make it past the first sentence without correcting that. You boost growth by increasing economic activity. In order to do that, you need new businesses and services and products being produced. In order to do that, you need new companies starting and creating those products, goods, and services. In order for those new companies to get started, you need capital, okay? Because it takes money to invest in machinery, to invest in materials, to invest in people, to write code, whatever it is. It takes money to start a business. And negative interest rates or 0% interest rates discourage savings. So the people that you want to, spur this growth won't have the capital because you've discouraged them from saving to invest in and start these new businesses. So, first sentence starts off with just this ridiculous fallacy that's based on Keynesian ideology. It's nonsense. Okay. And of course, here they admit 10 years later, interest rates remain low in most countries. While the global economy has been recovering, future downturns are inevitable. In other words, well, that shit didn't work at all. Severe recessions have historically required 3 to 6 percentage points cut in policy rates. If another crisis happens, and of course the IMF has been going around talking about storm clouds on the horizon and, massive global depression underway, few countries would have that kind of room for monetary policy to respond. To get around this problem, as if that's a problem, the real problem here is governments creating regulations, adding red tape, adding new, requirements, and throwing this all on businesses, making it more expensive for them to do business. They've been responding by, at the same time, inflating the money supply so that the dollar goes, the value of the dollar continues to erode, as well as other currencies all around the world continues to erode, and their money doesn't go as far as it used to. And so what do? Anything they can. They move production to another country where they don't have as much red tape, as much bullshit. Of course, minimum wage does the same thing. It kicks the bottom rungs out of the employment ladder, and these cheaper jobs that aren't worth whatever the minimum wage is just don't get done. So all of this stuff is very destructive, and that's the reason. That's how they created this problem that they're now telling us stealing from you is the solution to solving it. To get around this problem, a recent IMF staff study shows how central banks can set up a system that would make deeply negative interest rates a feasible option. Should play the hallelujah again. Okay, then they have a chart here showing every country but Iceland, Mexico, and Turkey have interest rates that are below 3%, and most of them are below 2%. You've got zero right here on this axis. And of course, that's the official rate. But of course, when you add in money printing, or as government likes to call it, inflation, inflation's not a natural occurrence in a free market. It only comes about because the government's inflating the money supply. They're creating creating money out of thin air without any accompanying value to go with it. And where does that value come from? Well, it's stolen from all of the existing dollars in circulation. So really, if they're paying 2% interest and the official inflation rate is 3%, then you're losing 2% or 1% a year in the value. Basically, if you have $1,000 at the end of a year, it buys $990 worth of goods and services because of this 1%, the 1% difference between, say, a 2% interest rate and a 3% inflation rate. And of course, those are the government numbers as well, which are pretty much a lie. So let's keep going. How low can you go? Well, in a cashless world, there would be no lower bound on interest rates. See, we just need to get rid of this dirty, pesky cash that people can use to do transactions anonymously without us being involved, or the banking system involved, where we regulate it and watch it. Once we get rid of that, then we can just do whatever we want. And that's part of the allure of cryptocurrencies and blockchains and all that. It's all very traceable unless you're using Monero or something like that. A central bank could reduce the policy rate from, say, 2% to -4% to counter a severe recession. And guys, you can trust the government. They're only going to do this in severe cases where there's an emergency. They would never abuse this power and view it as a new revenue stream. Trust them. The interest rate cut would transmit to bank deposits, loans, and bonds. Without cash, depositors would have to pay the negative interest rate to keep their money with the bank. Now, isn't that amazing? The idea behind a bank is you take your money, you give it to them, they invest it, and then they turn around and pay you interest on the money because they're, if they're paying you 3%, they're making 7%. And so you are paid a dividend on their investment. Well, now with this policy, you're the investment. You give them your money and they give you back less. It's a great deal. It's a wonderful system for them. Making consumption and investment more attractive. Of course, this has the opposite effect of growing the economy because, it takes capital to start a business. This would jolt lending, boost demand, and stimulate the economy. What a load of bullshit. When cash is available, however, cutting rates significantly into negative territory becomes impossible. Damn it. Cash has the same purchasing power as bank deposits, but at zero nominal interest. Moreover, it is obtained in unlimited quantities in exchange for bank money. Therefore, instead of paying negative interest rates, one can simply hold cash at zero interest. And of course, what they're saying there is a bank run. So in Cyprus, everybody was going there, pulling as much money as they could out of the bank. They put limits on how much you could withdraw in a day. And of course, why wouldn't you withdraw it? Because if you leave it there, they're going to take, 20, 30, 40%, whatever you're able to pull out, you get to keep 100% of that value. So you can't make them too negative currently with cash floating about out there. Cash is a free option on zero interest. Of course, you're still losing value to inflationary money printing, and acts as an interest rate floor. Because of this floor, central banks have resorted to unconventional monetary policy measures in the euro area. Interest rates can go slightly below zero, which has been possible because taking out cash in large quantities is inconvenient and costly. For example, storage and insurance fees. These policies have helped boost demand, but they cannot fully make up for lost policy space when interest rates are very low. So again, they can steal, a little bit. If you look at this chart, some of these are up, less than, not more than -1%. But if you make it too high, bank run. So breaking through zero, how do we fix this problem? One option is to break through the zero lower bound would be to phase out cash, but that's not straightforward. There's a lot of people that would openly revolt at such an idea. Cash continues to play a significant role in payments in many countries. To get around this problem, in a recent IMF staff study and previous research, we examined a proposal for central banks to make cash as costly as bank deposits with negative interest rates, thereby making deeply negative interest rates feasible while preserving the role of cash. Isn't that wonderful? And here they're showing countries, the percentage of transactions that occur in cash. The United States is kind of right here in the middle at about 8%, looks like. A little under 8. And Japan's upwards of 18%. The proposal is for a central bank to divide the monetary base into two separate local currencies, cash and electronic money. Now, if you've been listening to my channel or listening to me for a while, you know I've talked about Tier 1 and Tier 2 money. And I've had some questions around this. Well, this really clears it up for me. First off, Tier 1 money is going to be, in all likelihood, XRP. That's what the central banks in the various countries that don't trust each other because they're all a bunch of thieves, openly admitting it here. They want sound money that can't be inflated, that they can trade between each other, that doesn't have any one country that's in charge of issuance. And so that will be XRP. But then you have Tier 2 money for exactly what they're describing here, when they've choked off the economy too much and, they want to fix it by meddling further and distorting market signals and so forth, rather than letting it manage itself. Then what they can do is create a Tier 2 money, is always what I've seen, where they will be able to inflate the money supply. We want to go to war with this country. We need $1 trillion, $500 billion. Well, let's print that. Well, if you have XRP, you can't just create that. So I still saw them using a Tier 2 fiat-based money. But again, it's clear that everything's moving digital. So I kind of saw them maybe paralleling with something, and that's what they're describing here. So you have cash and you have electronic money sitting side by side, kind of working together. So let's keep going here. E-money would be issued electronically and would pay the policy rate of interest. So if it's negative 4%, they're going to just steadily steal money from you. And cash would have an exchange rate, the conversion rate against e-money. This conversion rate is key to the proposal. Yes, it is. When setting a negative interest rate on e-money, the central bank would let the conversion rate of cash in terms of e-money depreciate at the same rate as the negative interest rate on e-money. The value of cash would thereby fall in terms of e-money. So essentially, you can use cash, but when you deposit it in the bank, if you deposit $100 and the rate's negative 4%, we're gonna credit you for $96 in e-cash. You see what they're doing here? To illustrate, suppose your bank announced a 3% negative 3% interest rate on your bank deposit of $100 and negative 3%. Suppose that also that the central bank announced that the cash dollars would now become a separate currency that would depreciate against e-dollars by 3% a year. The conversion rate of cash dollars into e-dollars would hence change from 1 to 0.97 over the year. After a year, there would be a 97 e-dollars left in your bank account. You instead took that $100 out. After exchanging it into the e-money, you would also yield 97 e-dollars. So exactly what I just described there. You take cash out. When you go to put it back in, they just give you less in e-dollars and problem solved. You haven't gained anything by using money that the government and the central bankers can't manipulate. Isn't this a wonderful proposal? Aren't you all, just throwing your support behind it? At the same time, shops would start advertising prices in e-money and cash separately, just as some shops in some small open economies already advertise prices in both domestic and bordering foreign currencies. Cash would thereby be losing value both in terms of goods. It's not losing value. It's the central banks are stealing value from you in terms of good and in terms of e-money, and there would be no benefit to holding cash relative to bank deposits. Gee, what could you hold that wouldn't lose money? Can you say digital assets like XRP, Bitcoin, Litecoin, Ethereum, Monero? Seems like it. Anyway, and they go on and they're given their pros and cons. I will put this link to this in the video, but essentially this is how they're going to do bail-ins in the future. Rather than going into everybody's bank account and getting the whole country pissed off at you all at once and expending all that political capital, oh, it's just the exchange fee. That's all. You're just, we're just going to have this little debit, this little fee for negative interest rates. It's an emergency after all. It's only temporary, which means 2 weeks to 5 years. And yeah, it'll all work out. You just trust the government. They've figured out how to rip you off and make it look good. And this is their plan. And I think absolutely they're telegraphing this is what we're going to do. And they're letting all the central banks know this is our best strategy going forward. So, oh, wonderful. But should they start implementing this, it's going to push people into sound money, gold, silver, maybe platinum, but also cryptocurrencies, Bitcoin, Litecoin, XRP, Monero, especially Monero, because it is totally private. And that's how you can protect yourself from this kind of theft. All right, folks, I'm Sam I Am. We'll catch you next video.